Hi, everyone. My name is David Graver. I'm a Vice President of Retirement Plan Services here at Fort Pitt Capital Group. I'm here with Kevin Hefke, joined us in studio today, so lucky us. We'll talk about Kevin and I here in a moment, give us some introductions to everyone, but thank you everyone for attending. We're here to talk about cash balance plans today, which we're calling the business owner's secret investment weapon. So hopefully everyone gets something from this webinar today, learn something. They're really interesting products. People that are familiar with them, hopefully you learned something additional today, but people that aren't aware of the cash balance plans and what it does and what it could do for you personally or your company and organization, hopefully you really get something out of this webinar. So we're looking forward to presenting to everyone. So for anyone not familiar with Fort Pitt Capital Group, I know some on the webinar are current clients, but a lot of you are not. So a little bit about us. So we are a firm based in the Pittsburgh area, but obviously we have clients all over the country. So we pride ourselves in our in-house investment management philosophy, taking a fiduciary approach to that. But we give everyone, all of our clients, a nice boutique feel as well. So right now we're roughly 71 employees, and with that, that allows us, for each client has their own dedicated service team. If that's a wealth management client, if that's a 401k client, cash balance client, any of those, everyone gets the same level of attention. Really today we're concentrating on the corporate side of things, looking at employer-sponsored retirement plans. So I'm part of the team that we manage 401k plans, 403b plans for nonprofits, defined benefit plans, obviously cash balance plans fall in play there as well, but even looking at non-qualified plans as well, top hat plans, employee just plans to take care of executives, things of that nature. So, but with that, we take a holistic approach to the planning, and we work with everyone, and we work with all of your current advisors, your tax consultants, things of that nature. So our goal is our clients. So we're not there to make commissions. Our goal is to take care of our clients, and this is just another way of us doing that here today. So about our webinars, kind of building off what I just said, these are a resource for our clients. These are a resource really for anyone. I know a lot of you on the webinar today are not current clients of ours. So really, we provide these just to provide education on various topics, from Social Security. Our next webinar, for instance, is on elder care, and then today, obviously, looking at more employer-sponsored retirement plans. We want to bring information to you, but we also want to bring expertise to you. So that's part of the reason Kevin is here next to me today. So we're going to talk to you about a topic a lot of people don't know about. So hopefully it educates you and you learn something and can help you ultimately save for retirement and let you learn about these complex issues. So about me, so I've been working strictly in retirement plan services, so 401k plans and such, since 2007 after graduating from the University of Pittsburgh with an economics degree. So I work on every type of plan you can think of. I've worked with Kevin and his firm on a number of accounts. I've worked with all the record keepers out there, and I just really, really enjoy the corporate retirement plan side. So there's a lot of advisors out there that can do retirement plans, but they don't specialize in retirement plans. For instance, at Fort Pitt, we have dedicated teams. We have our wealth management advisors, we have our own planning department, we have our service teams, but we also have a dedicated just retirement services team, which I'm a part of. So we work with nothing but 401k plans, cash balance plans, pension plans. So we are specialists in that area. So really enjoy that, really enjoy being a part of the team here. And a little bit personal about me, I'm a car nut. So this weekend you'll find all the Graver men at the Vintage Grand Prix. I encourage everyone, if you haven't gone to that before, it's an awesome event. Check it out. It's rare you get to see old vintage race cars racing around the streets of Pittsburgh. So, yep. So a little bit about how to interact. So you'll see on your device, if you need to ask questions, if you want to access the handouts that we have there, you'll see how to do that. So you'll see the different buttons you can click for the handouts, questions. I think it's pretty self-explanatory. But we encourage everyone to ask questions, and we will get to the questions at the end, hopefully. Hopefully all of them. We'll get to some of them, that's for sure. And also, everyone, you will receive you will be emailed, everyone that registered, an email of the recording of this. So keep a lookout for that in your inbox. So today, I mentioned I have Kevin Hefke with me. So Kevin Hefke's with Dunbar, Bender, and Zapf, DB&Z. We'll probably use that a lot. Easier to say than Dunbar, Bender, and Zapf. So Kevin's a consultant for DB&Z. As I mentioned before, I've worked on various accounts with not just him, but also all the other consultants and the analysts and such at Dunbar, Bender, and Zapf. So so Kevin, you want to tell them a little bit about yourself?
Yeah, thanks, David. So I've been with the firm now for 10 years, right? But went to Duquesne University, studied mathematics and finance, and have all my certifications through our designated body, the American Society of Pension Professionals and Actuaries. When I'm not working or trying to educate our clients or existing clients or build new business for our firm, I'm out trying to swing a golf club, maybe not so well, but love to do it, or out hopping around. I live in the city, so always out looking for a new restaurant or a place to go hang out and listen to a concert.
Awesome. Cool. Great. All right, so let's get to what we're here for. So Kevin, correct me if I'm wrong, pension plans are dead. Nobody installs new pension plans anymore.
That's really a myth that we have here. It's really, maybe the expectation is that, the defined benefit plans are something of maybe our parents or our grandparents had, but they've really kind of gone the way of the dinosaur. But that's really not true. We've found that, over the last 10 or 15 years, cash balance plans specifically have really been the fastest growing type of retirement plan coming into place now.
Okay. Cool. And so your firm, DB&Z, so can you tell us a little bit more about them and how you guys work on not just pension plans, but specifically cash balance plans on top of the defined contribution work that you guys do?
Yeah, absolutely. So yeah, we were founded here in 1991, so we've been in business a little over 30 years. We're located right downtown in the Frick building. We've got a little over 70 employees and administrators. We work on all different kind of shapes and sizes of plans, whether they're traditional 401k profit sharing plans, these cash balance defined benefit plans that we're going to dive into today, then also ESOPs, and then offer 316 services to kind of help take some of that time and administrative burden off our clients' plates. And kind of what I like to always highlight about our firm, what I think is our greatest strength is the people that we have behind us, is that we have a qualified team, and when I say a deep bench, right? So we have teams that really specialize or subspecialize in each of these different plan types. We have 3 actuaries on staff, which, incredibly important, right, for the large book of defined benefit cash balance plans that we're going to dive into today.
Yep. So you'll see why Fort Pitt and DB&Z, we work so well together and work so closely together. We have a lot of similarities, client first approach, dedicated teams. So, that's why we're here to help you today. So I'll let you get into it, Kevin, about some cash balance plans, myths and realities.
Yeah, right. Like we talked about, they really are, it's a new type of plan, and really we should think of a cash balance plan as a hybrid type of plan between your traditional defined benefit pension plan that maybe we know has kind of been phased out for some obvious reasons, and then the 401k profit sharing plans that we all kind of know now that is the traditional employee benefit package. And it's a way really to focus the benefits on the employer and we kind of supercharge the benefits that they can offer while also helping them kind of reduce their tax burden along the way.
Okay. So so ideally, who's an ideal client for a cash balance plan?
Yep. Yeah, and that's an important thing to highlight because while we say that cash balance plans are rapidly growing and maybe the most quickly, they're not for everyone, right? It is a certain subset or it's a specific niche that really are going to make these plans go. So you're thinking about employers that are maybe already have a plan in place, but they're maxing that plan out and maybe hitting their head on the ceiling of what that benefit could offer, and looking around saying, hey, I wish I could do more, right? I'd like to save more, or I could use some more deductions for the business rather than otherwise paying that to Uncle Sam. A few other things to think about. They really don't start to make sense for somebody until you get into your 40s, right? And a lot of that is about the way these plans, without digging into the weeds of how the calculations work, right? We're looking for an ability to have an age disparity between the owners and the employees so that we can provide a larger benefit to the owner. Well, of course, bringing a benefit and bringing the staff along, but knowing that, really the focus is the business owner here.
Okay. Yeah, because let's face it, like the fact is a lot of business owners, a lot of them aren't able to really fund their retirement to the level they want to early in their career,
Right.
because they're building their business, they're funding the business, putting the money back into the business. So, but later on, when they're in their 50s, when they're in their 60s, they are doing well. They have really a surplus of cash. I know our wealth management clients were always looking at ways where they can not only save more, but shelter money away from taxes, things like that. And that's where a cash balance plan for some of them can really come into play. You know, you're looking at your doctors that have the health practices, dentists, things like that, law firms, smaller law practices. There's a lot of opportunity for those situations for the owners and also some of the employees of there to really benefit from these plans.
That's exactly right. And we think about, those clients, right? They've, put their kids through college. They're ready to focus on the retirement or even, business succession planning,
Yep.
right? You have younger partners in, you want to be able to transition the business, whether that's through a family or just through, a transition of partners in some of those closely held firms. This can really be a powerful tool to do that in a more tax advantageous way so that you're, leveraging this plan as a way to structure a buyout and a sale and transition in the business.
Awesome.
Yeah.
What are some of the advantages? So you're looking, I think a lot of people are familiar with just how a normal 401k or other defined contribution plan works, but what are some of the advantages of these cash balance plans?
Yeah, I'd say first and foremost, right, the biggest use and strategy for these plans is an ability to, defer taxes, right? It's a way to have a much larger deductible contribution from the business, and by doing so, using that deduction to fund a benefit to the owners. So that's really what we want to focus on, right? Is, there's a large benefit available, and we'll kind of get into what some of those numbers are. And I think it will be eye-opening for some people to really see what you can put away as an above and beyond. But it's important to, that's kind of where these plans come into place and where those discussions happen, particularly with their advisor or their accountant that says, man, you could really use another couple $100,000 as a deduction that you're otherwise just paying taxes on this money.
And two, you mentioned employee retention. So think about that. If you have a competing firm that you're losing employees to, or you really are just hoping to retain employees, if you're able to say to one of your key employees, like, not only do you have a 401k plan that maybe they're doing the safe harbor contribution to, that is with a great provider and they're working on them there, but hey, we also have this other benefit that essentially is working like a pension plan that is going to pay you on top and give you help prepare you for retirement. That honestly, that really helps. It helps attract employees if you're looking to attract those key employees, but it really does, it helps with employee retention. So these can be key.
Yeah, that's certainly the case. Yeah, and really, when I talk to business owners now and we're putting plans in place, what I hear the most is, I need to have a plan in place because my competitors all have it, right? Having a 401k plan essentially is table stakes at this point if you want to be able to attract and retain good employees in this environment that we're in. And so putting in this supplemental plan, this cash balance is going to hopefully make employees stickier and really set yourself apart from some of your competitors in a way to, not only reward yourself, but reward your employees and let them know you really care about their well-being and their ability to retire.
Okay. Awesome. Cool. So now these do work a little bit different, actually, very different than defined contribution plans, 401k plans. For instance, investment-wise. So this is where these plans you really have to rely on the experts that you're working with, from an administration side and the actuarial side with DB&T, for instance, but also your advisor. You take Fort Pitt Capital, for example. So these are pooled investment accounts. So unlike a 401k plan where employee is presented with a list of investment options and they go in and they monitor their investments, if pick and choose things on their own, or their advisor picks and chooses things on their own. This is a pooled account. So really the investments and really the interest crediting, that is set in the document. So this is all set. So it's employees aren't able to go in there and pick and choose things on their own. What they're going to get a yearly statement that is essentially a hypothetical account balance on an annual basis that is going to show them what they've accrued to this point and really what it's going to look like when they do retire or they do leave employment there. And unlike a normal pension plan where a lot of times your only option is to take an annuity type payment, When people do separate from employment, they're going to have the option of taking a lump sum or doing other things with it, rolling it into a rollover IRA. So there's various options they can do that presents itself, but also for the employer as a protection. Correct me if I'm wrong, you could do a 3-year cliff vesting.
Yes.
On these plans too. So you don't have to worry if you make a contribution for an employee and they ultimately end up leaving after a year. Well, you know what? They're not going to be vested, so you'll be able to take that and really put that back into the plan or use it for other plan expenses. So, which is similar to a 401k vesting schedule. So,
right.
But again, so you'd have an interest crediting rate that is set in the plan document, and it's typically about 5%. They do require annual employer contribution, so this isn't discretionary. You can't say, hey, I'm not making a contribution this year, like you can do in a 401k plan, depending on how your document's written. So these are required. It'll be a multi-year commitment, so you're going to want to look at having this plan in place for at least 3 to 5 years. And I mentioned participants will receive statements, so they can kind of compare that to and couple that with their 401k statements. But it's not going to be different. It's going to be different than the K plan. They can't log into Fidelity or Empower, for instance, and look at their 401k balance. Like look at their cash balance as they can with a 401k plan. But again, they're still easier to understand than a pension plan. So really, you're not going to have to, for the most part, you're not going to have to worry about your pension plan being terminated, frozen, things like that. These plans are set up with the goal because the money's there to fund them and ultimately provide more benefit for the business owners and employees. So, and the nice thing too, maybe if you want to touch on this a little bit, cash balance implementation deadline because of the Secure Act was extended. So you want to talk about that?
Right. Yeah, and this is one of the things, right? We won't always say this, but the IRS really got this one right in making this change a couple of years back, and being able to really delay the decision to put one of these plans in place. Because, like David talked about, right? We know you've got to have this plan. You've got to be able to commit to at least 3 years. And so, when we're talking about, and like I said, we're going to get to the numbers, but significantly larger contributions, and you've got to be able to make a commitment. It's hard to maybe forecast 2 or 3 years out. And so what this change has done is it has allowed us to retroactively put these plans in place for a prior year up until your tax filing deadline. So I'm still working with clients right now that are running the numbers and realizing, 2021 was a great year. We're halfway through 2022, forecasts look great, and 2023 seems to be on track. Now we can make a decision to retroactively put that plan in place, fund it for 2021, and then know we're in a good spot and not have to kind of fly blind by putting that in before the end of the calendar year, which is what used to be the case. So it really allows a lot more flexibility and allows the business owner, their accountant, and their advisor and everyone in the picture to really make a more educated determination of, does this make sense? Is this the right fit for me before you sign on and commit to putting it in place?
Yeah, no, that's key. It really is. With everything that happened with COVID and such, the flexibility and a lot of things that changed in the defined contribution and just the overall, ERISA and the DOL and IRS actually did some really good things there. So
yeah,
so I agree with you. So when people ask me, what is it? How do you describe a cash balance plan? That just really quick, cliff notes on it. I'm like, honestly, it's a way for business owners to super fund their retirement. Most of them. Again, we mentioned this isn't for every single business owner, but for most business owners, yeah, this is a way for them to absolutely super fund their retirement. And this next slide is really going to show you why. So if you can go over some of the numbers here, Kevin.
Yeah. So, those of you that maybe have a plan in place currently or have looked to put one in place, those first 2 columns probably look pretty familiar, right? Those are what you can fund as an individual in the 401k as a 401k pre-tax or Roth contribution. And then if we were to bolt on maybe a safe harbor and profit sharing allocation on top of that, in a traditional 401k profit sharing plan, right, you're capping out at $61,000, $67,500 depending on your age. Well, we shift over to the 3rd column, right, and these bands look at what you can put in as you add this supplemental plan. And as you can see, right, that's where we talk about it really starts to really go. This engine starts to run when you get into your 40s, and as you can see, as you really get up into your 50s, and those are in addition, those are right startling numbers, right? Those are numbers that these are deductions for the business that can not only reduce your tax liability, but these are contributions going to the individual owners, not not a total plan contribution. And this is to show right with the max that's available. We would always write the document in a way to target you know, hey, I'd like to fund an additional 150 on top of that, even though I know I could put 250 in. And that's where, you know, it's important to know there is a lot of flexibility within that design. But, you know, when we run these illustrations, and that's typically what we would suggest, right? If you're looking to put one of these plans in place, is, you know, you talk to David, talk to your accountant, and they'll provide us some of the, you know, numbers we need to run. And then when we sit down with the business owner, and I laugh only because I've had multiple people look at me and, you know, they kind of give you a side eye and say, really, this is legal? I can really put another $250,000 and that's all a deduction, and it's 90% of those dollars are going to me.
Yeah.
What do I do next? Yeah.
Yeah. And this is per year. So you're,
Right.
you're looking at that, you know, a 63-year-old business owner can be putting away an additional 301,000 roughly 1 year at a time. So, you know, if they're looking at retiring, they're looking at, you know, they're in the twilight of their career, maybe passing it off to the next generation or some other successor, but they really want to fund that retirement at the end. Like, there's no better way of doing it than this.
Right. So, yeah, and maybe we'll just kind of talk on what we can hit as far as, you know, we talk about, you know, the 3-year minimum. There is also a ceiling on these plans, right? A little different from a 401k plan where, you know, you can fund it as long as you want, and whatever you can make the investments earn, that's great. Once your accrued balance in this plan, you know, they cap out at 3.1 million. So, you know, once we hit that number, that's, you know, congratulations, you've made it, and we terminate the plan. And as David said before, right, you roll that balance out to an IRA, or
Is that accrued per participant or plan as a whole?
per individual.
Okay.
So typically, right, the business owner or owners, their accrued balance, it's 3 million. It's not a total plan balance.
Okay, great. So let's take a look at some of the design considerations, and ultimately, you know, what's the goal here?
Yeah, right. The goal is, again, we're going to harp on driving down your taxable liability, and, you know, accelerating retirement savings for the business owner. Right? They're hitting their head on the ceiling. They want to save more. They want to maybe, you know, save more for put more in place for their employees so they can retire with dignity and, you know, retire on time, so that, you know, healthcare costs don't become an issue down the line, right? You want to be able to take care of your people and identify people that are good for you and provide them an ancillary benefit.
But the thing too as well, with this cash balance plans, you are able to carve out certain employees or certain classes
You can.
of employees.
Yep. So there's a way to kind of identify key employees that you want to cover, and then others that you don't. And we won't maybe get into the weeds of what that all looks like exactly, but know that you can cover only a subset of employees in this cash balance plan to help drive down costs and make it more efficient.
Yeah, so that's key. I know, because a lot of people are worried, like, hey, I would love to do this for myself. Not saying I don't want to take care of my employees, but if I'm looking at the overall cost, if I have to cover every single employee on here, ultimately, is it going to be worth it, or is this going to be too big of an expense for the business? And, you know, that's a way where you know, you can help prevent that. So I think, Kevin, we're going to go through a few examples right now, and kind of see exactly how these work, and give you guys some real, you know, scenarios that you can look at.
Right. So that's, you know, like we talked about, there are a lot of ways where this plan can fit, right, or why it makes sense. So let's look at an illustration where, you know, you've got an owner of a business, they have a few children that are in the plan. Maybe the son's going to come in and is going to ultimately take over and run the business going forward. Father wants to retire, wants to be able to transition ownership, but again, we talked about probably doesn't really have much retirement savings because, you know, all of that money has been reinvested into the business, right? Or putting the kids through college, paying for a wedding or two, all of those things. And so we're going to look at an example of how we can leverage this plan to, you know, kind of supercharge or backfill dad's retirement so that the kids can kind of come in and take over, and structure that in a way that it's more tax efficient for them and the business.
Okay. Here we go.
All right, so I know this is maybe not the prettiest Excel spreadsheet to PowerPoint example, but, you know, let's take a look at this kind of middle column where we're showing the cash balance amount, right? So that's where we've got the owner, that's dad, who we're going to focus on the larger benefit. And so we're going to put another $264,000 in on top of, you know, what we're funding to the profit sharing plan. The kids, and, you know, they've got a manager there that's, maybe a key person. They want to provide them a benefit in this plan, but they're not the priority. The priority is to the business owner. And, so what David's point a few minutes ago, right, is, here you see the salespeople are not receiving a benefit in that cash balance plan. And that's typical in the sense that, we're going to identify maybe a subset where we want to carve out, and it's okay to do that as long as we can definitely determine those employees by their rank, right, or their job category. We're not going to say Mike, Sally, and Jim, I want them to be in the plan, but Jim and Tom, those guys aren't great, they're out. But salespeople, we can say, hey, I already pay them a good wage, maybe they make commission and bonus. We don't want to commit to this ancillary plan for them. They're still covered in the 401k profit sharing plan, still have access to that, but that way we have a lower cost on the staff side to put this plan in place and really, again, focus on getting dad and the owner a benefit over the next few years so that he can retire and the kids can come in and take over.
Yeah, and you look at that cash balance amount column where the owner is putting away additional $264,000, but the total that is going into this plan is really just another $10,000 at $274,000. So,
right.
That business owner is able to really, like I mentioned before, super fund retirement, and it's not costing he or she a lot more on top of that for them employees. So again, that could be changed if they wanted to do an additional amount.
Yep.
Like if they are very paternalistic or maternalistic and really want to take care of some other employees or partners, that can be done. But just showing you an example, if really the ultimate goal is to set aside as much as possible for that owner of the business, this is just an example showing that. And I think it's pretty powerful. And then, looking at the overall total contribution amounts, showing you from the total 401k contributions, to the total, obviously cash balance contributions. It's really neat to see this in place. I know Excel spreadsheets, as you mentioned, are a beautiful thing, but when they have numbers like this, it really makes it easier to look at.
Yeah, they do. They make the eye pop, right? And like you highlighted, right, 91% of every dollar funded by the business is going to the owner. And again, that's where we highlight that's the goal, is how can we do that? And not to say that we, to minimize the staff cost, but that's what we're going to show. And then from there, we dig in and say, okay, well, that's great to know this is my max, but I want to target this amount and I want to identify maybe above and beyond, right? These two employees I want to give, and that's, again, we want to highlight that there are rigid boundaries for putting these plans in place, but there is a lot of flexibility once the plan is up and running on who we can identify to receive a benefit, whether that's multiple owner partners in the plan or even individual rank and file employees. You may have a one or two key people you really want to stick around, and you don't necessarily just want to give them a cash raise, and it's more efficient for you and them to be able to fund an additional benefit for them in this retirement plan, maybe above and beyond what some of the other employees are receiving.
Okay. I'm thinking too, I work with a lot of kind of stubborn blue collar business owners. And, for example, like my retirement, I know I have to have a 401k plan, but my retirement is the business. That's my retirement. I'm going to sell it. Well, that's assuming you're going to have a buyer. That's going to assume that someone that's a profitable business at the time. There's a lot of assumptions you have to make. Whereas you can put this in place and then ultimately, you can still sell your business, you can do all those things, but you would have this account set up that really is your retirement. You mentioned over $3 million that you could put in here. I think that would be a nice nest egg on top of everything else you can have set aside for retirement for these owners.
Right, especially if those monies that you're funding each year are money you're not otherwise paying taxes on, right? Exactly. Or receiving a big tax break. It's there's no reason not to take advantage of what's available, even if selling the business is your ultimate goal. It's good to have a backup, right? Or have some supplemental income to be able to put aside along the way and let the business and let the the government subsidize some of that if they can.
Yep, sure. Everyone loves paying taxes, right?
Right. Yeah. Right.
So here's another one. So the goal is deductions on some ancillary income that someone might be making.
Yeah. And so this is, maybe a little different from your traditional cash balance candidate that we've been talking about, but I think it still really fits into this topic, and it's maybe not as talked about as it should be, especially for these type of business owners or even, high net worth employees that maybe have access to an employer retirement plan. So maybe think of a, physician that works for a hospital, right? Or an attorney that, works for a law firm. They have a plan, they're maxing out their benefits and what the company offers them there, but maybe they have a side business, right? They do some consulting, or they sit on the board somewhere and they've got some ancillary income that they don't otherwise need. They're doing well, and they just really would look to find a way to shelter and hide's not the right word, right? But shelter as much of that money and defer the taxes until you need to take them. And so this is another way to put a solo plan in place.
Okay. Yeah, because I know you mentioned consultant. I know a lot of people, they retire and then they don't officially retire. They do some consulting work. And right. A lot of times they're paid a nice wage to do that consulting work, but maybe they don't necessarily need all of it.
Right.
So,
yeah, and so this is a way to kind of take a look, right? And let's just use the example. And this is a consulting client that they've got $100,000 in Schedule C income that, like I said, don't otherwise need. And traditionally, right, they talk to their accountant, and the thought is best they could do is open up a SEP, right? And you could fund 25% of your recognized compensation into that SEP, and that's great. $25,000 off of that, especially if you don't need that money, is a great way to shelter what you can. But putting this solo defined benefit plan in place is going to allow you to significantly increase that. And in this individual, and they're not even, they're 48, right? If somebody that was maybe 58, we'd be able to put probably close to 100,000 of that away, that full amount away. But this person's still going to be able to make a deductible contribution of almost $68,000. And so now, their net earned income after that contribution is only $25,000, rather than, funding 25 and still having 75 as taxable income. It's really a powerful way to again, protect and shelter some of that money in a way that allows you to defer taxes and be more efficient with how it's used.
Wow. Yeah, that's pretty amazing. Yeah, because think of it, that reducing your taxable income, that is key. A lot of people,
right,
even just deferring the 401k plan, that's a big thing. We're meeting with employees in educational sessions, talking about the pre-tax contribution, how that is going to reduce their taxable income. This is a way to kind of do it for those consultants or everyone with those side gigs to really do that in a really tax efficient way.
Right.
So you have some other consulting considerations to consider.
Yeah. So let's kind of talk about, right, let's get into the weeds of a little bit of, once we decide, hey, we think we're a good fit, we'd like to take a look at this. And let's maybe look back to the example we talked about with, the business owner that had their kids in the plan. Part of what makes that more efficient and beneficial is that, basically what we're doing in our firm on the compliance and administrative testing each year is we're testing two groups of employees, right? The ownership group and then the rank and file. And so if the plan is able to be in place and you have a couple owner employees, which, ownership is going to be attributed to any family members that, that actually work in the business, right, and take a wage. If we carve them out of the plan, just like we would maybe the salespeople, and don't offer them a benefit, it helps water down the testing in a way that allows us to more efficiently provide that large benefit to who we're really trying to target. And not to say that, again, like a spouse or a child can't still receive a benefit in that plan, and we would have them, make 401k contributions, but there are other, it's about the flexibility is really kind of what we want to drive home of ways to make this more efficient.
Okay. I think we may have mentioned a little bit, but I don't think we really got into the weeds. Like, are there any certain types of, companies or that or clients where this wouldn't be a good fit for? Like, who would, like, if off the top of your head, is there anything where a cash balance plan is like, what, that industry, it's just not going to work out the way you're structured, the number of employees? I know that comes into play a lot, the number of employees, but if you have any that you can talk about.
Absolutely. So typically, right, we're going to see these plans. You're about 25 employees, not much more. Reason being, right, as we talked about, the staff cost really starts to creep up on you as you have more people. And, we can be creative and find ways to, carve employees out if there's a way to definitely determine that they work with one class of employee versus the other. But again, once you get above there, you're bringing a lot of staff along for the ride for an increased cost. And, maybe the goal, again, is tax deductions and for the business, and that's okay, you don't mind. But otherwise, again, it starts to get expensive and less efficient for the business owner. Other things I get a lot of questions, right, from attorneys or businesses, maybe they had a great year, right? They crushed it. They got a $2 million settlement, or they had a big deal come through on a consulting business. They've got a huge year. They've got to try to, shelter as much money as they can from taxes. They really don't expect to be able to replicate that income over the next few years. This is not going to be a good fit. When we go back to talking about, that minimum 3-year commitment, that's not just I'm going to be able to have this plan open. It's that I'm going to be able to fund it and make level contributions for those few years. So, things like that, industries like oil and gas tends to be very cyclical, right? And so, again, anyone doesn't have consistent revenues and isn't comfortable committing to that 3-year contribution, they maybe want to take a step back. And again, we now have a little bit more time. What the IRS is allowed to delay that decision, but I think, again, we want to highlight that you do want to be able to know you can fund this plan for 3 years before you jump in.
Yeah. So the consistent revenue, that's key. I know we talked, I think last week, like oil and gas industry. You think about it a few years ago here in the Pittsburgh area, boom, and then not so much. Yeah. So that's just an example of one where you have those inconsistent revenues and such. So interesting. Okay. So I know we have really the presentation part is really done of what we wanted to go over, but we know we have some FAQs that we've done. We've had a lot of discussions with people about these, so we have some questions that we know probably would have come, so we're going to answer those ones first. So I'll let Kevin rattle these ones off of, the first one really, what if one of the business partners leaves or dies, unfortunately?
Yeah, so no, that's a great point, right? And let's talk, and it goes back to the idea of, we can have multiple business owners or partners receiving benefits in this plan, and they don't have to be the same. So as long as, let's say somebody passes away, right? Or they decide they want to leave, they, just like really a profit sharing 401k plan, they would roll their balance out. And as long as the plan wants to continue funding, the owner that remains still wants to put that in place, that's not going to affect the ability to keep this plan in place.
Okay.
So it's important to know, right?
Yeah.
That there's flexibility there between, individuals and what you're funding on an annual basis.
Okay. And is the owner, are they able to change their level of contribution?
They can, right? And so again, a lot of what we're going to show you when we run some illustrations and projections is, hey, what's the maximum amount that I can fund? And then we'll maybe, key it down from there, right? I might show you that you can put $250,000 a year, and you talk to your accountant and they say, well, really, we're just looking to put another 150 away. Say, great, that's what we're going to target. And then maybe 2 years down the line, things change and you want to boost that number up. Or, on the flip side, right? Maybe it's, hey, I've got some equipment I need to buy. I want to be able to kind of bring that number down for a year. That's all fine and well. We can adjust that on a year-to-year basis as long as, again, we're making contributions. And really the key is not cutting back benefits to the staff. That's really what the IRS is looking for with some of these permanency rules in place, is to be able to know that it's not a kind of one and done situation. But, to keep in mind, right, we talked about the ability to retroactively put these plans in place. If we want to change the benefit level year to year, that is something that's hard written into the plan document. So if we are going to change that for any year looking forward, that change and amendment needs to be put in place by the end of that calendar year for which we're going to make a change.
Okay. That leads to really kind of the next one. Why can't I fund the maximum every year?
Yep, great question. And again, another one we get asked a lot. And this is also, it kind of plays into David's role in when we're managing the investment account, right? So because it's a defined benefit plan, there are still minimum and maximum funding levels that need to be adhered to, right? Excuse me. You need to be able to cover a certain balance, know that you can cover the liabilities, but you also can't overfund it. The IRS is going to slap your hand, and at that point, it no longer becomes taxable, or you're going to lose that tax qualified status if you get to an overfunding situation. So what we're going to show you each year when we prepare the calculation is, hey, here's the minimum you need to fund to make sure this plan stays, adhering to the levels. Here's the maximum you can put in for this year. And we're going to give you a sweet spot. Here's where we would recommend you fund. And from there, you can make a decision, and you might know, hey, next year I'm going to buy some equipment, so my numbers, I'm not going to be able to fund as much. I'd like to fund the maximum this year, knowing that next year will be a little lower. And that's kind of where it becomes, it is very much a holistic approach and consultative approach on these. It is a team effort. We all need to be on the same page, meaning our firm, David and their team, the accountant and the business. No one can surprise the other, right? We've got to all understand what the goal is and what we're trying to accomplish so that we can make this happen.
Well, I think we had a question that comes in that kind of plays right on that. So when does the plan have to be funded?
Yep.
In a year.
So similar to just like a 401k or a profit sharing plan, any employer contributions need to be funded by your tax filing deadline. And that can be done with extension. Our deadline being September 15th. So even if you are a 10/15 extended filer, that's a DOL rule that, specific to defined benefit cash balance plans, that the deadline for that would be September 15th. And let's maybe kind of just stay on, right, when we're funding, let's talk to you about how market fluctuation can affect, right, when we talk about minimum and maximum. So David's role is going to be, as we talked about, trying to mirror that 5% interest rate as much as possible, right? And there are years like this year where that's more difficult than others, right? Yeah, not for David, but maybe for others. So what we talk about is, and that's okay. And the IRS and the DOL know that, and they recognize that no one's going to be able to necessarily hit that bogey every year. And so there are kind of, say, guide rails in place. So let's say the real return for the account is 0%, which could certainly be the case because these are going to be more conservatively invested to begin with. That's maybe not the worst thing in the world for someone whose real goal is, additional tax deductions, because you can make a larger contribution to the plan than maybe your age and income would otherwise allow in order to make up for some of that investment loss. Now, the flip side of that being, right, if the market takes off and all of a sudden that account returns 10%, well, now we've kind of shot ourselves in the foot because we were targeting a $250,000 deduction for the year, but because the account, returned what it did, we can't fund that full amount or we're going to get into an overfunding situation. Okay. So it really is, more than anything about an ability to save on taxes and defer that more than it is, how can I knock it out of the park with investment gain?
Cool. Yeah, it makes sense. And, again, that's why I mentioned the advisors that you work with are key on plans like this, so, and really the last thing we want to cover here is ultimately, if you need to terminate the plan, how do you go about doing that? Right.
So again, pretty similar in the sense to, a traditional 401k and profit sharing plan. And, you get to the point where you say, hey, I've hit my number that I want to hit, or, I'm going to sell the business, we're going to wind this down. Or even maybe, your employee demographics have changed and that you've grown, or, some of your younger employees have left and the numbers just no longer make sense for this to be an efficient way to fund a retirement benefit for you. Then we will, do a resolution to terminate the plan, kind of do a final calculation to show, hey, here's everyone's balance. And let's say maybe the plan is 95% funded at that point, right? So the employees are always going to get their full balance plus the 5% interest rate that they've accrued up through the termination process. Yep. And then at that point, the owner will have a decision to make to either, take a cut on what's left in the plan as far as that additional 5% of maybe underfunding. They can just take the residual balance, or they can choose to make an additional deductible contribution to get that plan to fully funded. Okay. At which point, right, we'll prepare distribution forms. As David said, right, everyone's going to have a clear stated lump sum balance. And at that point, they can make a decision to, work with David and his team to roll that out to an IRA. Maybe you're only shutting down the cash balance plan, but keeping the 401k plan in place. So a lot of employees will choose to maybe consolidate those distributions back into the 401k plan so that everything is really under one roof, and, or out to an IRA. And then you wait and take the tax hit when you're ready and start taking distributions.
Great. Okay. Yeah. I think that clears up, a lot. And I think we covered really, all the meat and potatoes of the cash balance plans, and looking at those numbers, I think is really eye opening. So hopefully people saw that today and really got people thinking, and we'd love to talk to you about that more. We did receive 2 questions that one of them, I apologize, we need a little bit of more info on. So we're going to email you kind of outside of the webinar to answer that question for you. Just need to get chat a little bit more with you and get some details on what exactly you're asking. But the other one was, do you have to have an existing 401k plan or other defined contribution plan in place to have a cash balance plan? So I'll answer that briefly and I'll let Kevin add anything on. So the answer to that technically is no, but you don't have to have an existing 401k plan or a plan like that. However, they really should work and coincide with each other. And really your consultant that you work with should help kind of direct that and making sure everyone's maximizing savings as much as they can, especially the business owners, and work, in cohesion with each other. But so yeah, the answer is that you don't have to, but really you should.
Right. And really, kind of goes back to, what you outlined at the beginning of really the difference in how those funds are invested, right? The reason why you would want to, even if you're starting from scratch, right, put both plans in place is when we do our testing on our side, we're going to test these plans together. And so, really what we're going to do is fund the majority of the employer benefits to the 401k profit sharing plan so that it's the employee's responsibility to direct those investments, and a minimal balance is being funded for the employees in that cash balance plan because the employer is committing, like those are guaranteed benefits for those employees. So there's a minimal benefit there, and you're giving the larger portion of that over to the 401k plan, and profit sharing has a longer vesting schedule, and again, the goal being employees are responsible for directing those investments.
Exactly. Cool. Great. Well, if there's no other questions, that's really all we have for you today. Kevin's contact info is here. Again, you will be emailed the presentation, and also I just want to remind everyone of some upcoming seminars and webinars that we have coming up. It's irony that the one on August 25th, Elder Care, is actually my 40th birthday. I think they did that on purpose, So that's coming up on August 25th, and then also on September 21st is an ESOP right for your business. So obviously that's a business-focused, retirement plan side of things too that we're going to love to talk to you guys about then. Then the last page is the most exciting slide we have. No, not this one. So ignore that. There's my contact info. But the most exciting page is the disclosure page. So I had to make sure I get that in there to make compliance happy. So again, I want to thank everyone for joining us. Thank you to Kevin for coming in.
Thank you.
So we love doing these for you guys. Hopefully you learned something today. And we're going to reach out to every single one of you and see if there's anything additional we can do to help you. But in the meantime, if you want to reach out to us, please do so. Thank you, everyone, and have a wonderful day.
Take care, everyone.